You've heard the name a million times, right? On the news, in articles, the Fed. It's this big, mysterious institution that seems to control everything from interest rates to the job market. And you know what? It kind of does. It affects the cost of your mortgage, your car loan, even the value of the cash in your wallet. So what is the Fed really? Well, in this explainer, we're going to pull back the curtain on the powerful central bank that steers the entire U.S. economy.
All right, so here's our game plan. First, we'll cover the basics. What is this thing? Then, we'll dive into its two main goals. It's a real balancing act. After that, we'll look at the number one tool it uses to get the job done, figure out who's actually pulling the levers, and finally, bring it all home and talk about why any of this really matters to you.
Okay, first things first. What is the Fed? And to really get it, you got to understand that it wasn't just created on a whim. We have to go back to its origin story. So picture this, an economy with no safety net. For decades in the late 1800s, the U.S. was hit by one financial crisis after another. Bank runs, chaos, it was the Wild West of banking. The final straw was a massive meltdown called the Panic of 1907. That disaster finally convinced Congress, okay, we need a grown-up in the room. We need a financial firefighter. And so, in 1913, the Federal Reserve was born to bring some stability to the system.
Now, most of us only hear about the Fed, interest rates, but its job is so much bigger than that. It has 5 massive responsibilities. Yeah, it handles monetary policy, but it's also supposed to keep the entire financial system from falling apart. It supervises individual banks, it makes sure our payment systems, checks and digital transfers, work smoothly, and it even has a role in consumer protection. It is a huge, huge job.
So, let's zoom in on that first function, the one that's always in the headlines, conducting monetary policy. See, Congress gave the Fed 2 main goals for this policy, and sometimes they don't play nicely with each other.
So what even is monetary policy? Here's the easiest way to think about it. Imagine the economy is a car. Monetary policy is basically the Fed using the gas pedal and the brake. By changing interest rates, it can either speed the economy up to create jobs or slow it down to fight inflation. It's all about trying to keep the car running smoothly without overheating or stalling.
And this right here is the Fed's ultimate tightrope walk. It's called the dual mandate. On one side of the rope, they have to push for maximum employment, a strong job market where anyone who wants a job can find one. On the other side, they have to maintain stable prices, which means keeping inflation low and steady, right around a 2% target. And here's the really tricky part. Hitting the gas to help jobs can cause the economy to overheat with inflation. Hitting the brake to cool inflation can cause people their jobs. It's a constant balancing act.
Okay, so the Fed's got this massive job, this dual mandate. But how? How does one institution actually influence an economy with over 300 million people? Well, it all comes down to its main tool.
The Fed's number one tool is something called the federal funds rate. Now that sounds super technical, I know, but all it is the interest rate banks charge each other for overnight loans. You'll never see it on your bank statement, but just think of it as the base level, wholesale cost of money. And by nudging this one single rate up or down, the Fed starts a domino effect across the entire economy. And here's exactly how that ripple effect works. The Fed announces its new target rate. Almost immediately, banks change the rates they charge us. Suddenly, your credit card rates, car loans, and yes, even 30-year mortgages all start to dance to the Fed's tune. That change in borrowing costs makes us and businesses rethink our spending. All of those millions of individual decisions added together are what ultimately steer the whole economy. So who exactly is turning this control knob? Who are these people making these huge decisions? Well, the Fed has a really unique structure. It was designed on purpose to be independent from day-to-day politics, but also to represent the entire country.
The Fed isn't just one building in Washington, D.C. It's actually a system made of 3 key parts. You've got the Board of Governors, which is the central government agency. Then you have 12 regional Federal Reserve banks scattered across the country. And finally, you have the FOMC, the Federal Open Market Committee, which is where those 2 groups come together to make the big calls.
So here's how they all fit together. The Board of Governors in D.C. provides the top-down oversight. But the 12 regional banks are the Fed's boots on the ground, their eyes and ears, gathering real-time data on what's happening in their local economies, from Boston to San Francisco. Then they all come together for the FOMC meeting. This is the room where it happens. The 7 governors and 5 of the bank presidents sit down, they debate, and they vote on where to set interest rates.
This quote from Fed Chair Jerome Powell really nails the whole philosophy. The Fed was designed to be independent, so it could make tough calls based on economic data, not because of short-term political pressure. But, and this is key, that independence means they have a serious obligation to be transparent so that we, the public, can hold them accountable for their decisions.
And here's a wild fact most people don't know, and it's a big part of that independence. The Fed isn't funded by Congress. It doesn't get a budget every year. Nope. Its operations are paid for by the interest it earns on government securities that it owns.
And get this, not only is it self-funded, the Fed is a massive moneymaker for the government. After it pays its own bills, all the leftover profit gets sent right back to the U.S. Treasury. In 1 year alone, that was almost $87 billion. That's not going to private banks, it's going right back to the government.
Okay, let's bring it all home. We've talked about committees and rates and mandates, but why should you actually care? Because what happens in those meetings in Washington, D.C. directly, and I mean directly, impacts your wallet. Nothing shows the Fed's power like a crisis. Just look at this. In response to the 2008 financial meltdown, and then again when the pandemic hit in 2020, the Fed acted fast and went big. They slammed interest rates down to basically zero. This was the economic equivalent of calling in the cavalry to save a struggling economy.
And this is where it all comes together for you. Thinking about buying a house? The Fed's decisions influence your mortgage rate. What about that credit card bill? Yep, the Fed's in there too. It even affects how much or how little interest you earn in your savings account. Beyond that, its policies on employment can impact your job security, and its fight against inflation affects the price of everything you buy. It's everywhere.
So when you boil it all down, the Fed is part financial firefighter, part economic mechanic, and part high-stakes tightrope walker. It was created over a century ago to bring stability, and today it uses its powerful tools to balance those critical goals of keeping people employed and prices stable. Its role has never been more important. The real question, though, is in a world that keeps getting more complex and unpredictable, are its tools powerful enough to handle whatever storms are on the horizon?